What's up YouTube? Welcome to the channel. So I want to start with this picture. If you had invested in the S&P 500, which is the representation of the biggest companies that are quoted on the stock exchange in the US, if you had invested in this ETF in January, you would have put in about $450 per unit of this ETF. What is that worth today? As you can see up here, that has gone from $450 to about $366. That is a 23% drop in the market. A lot of people are panicking because the downward trend seems to still be continuing. People have bought the dip, the dippity dip, the dippity dippity dip. Nothing seems to have turned round. But there are opportunities, and this is what we're going to talk about. Even in a downward market, there are still opportunities. Today, we're going to talk about the covered call as a potential tool that you can use to generate revenue for yourself in spite of the fact that the market is going down. All right, let's get it. So in today's video, we're going to talk about how you can use covered calls on dividend generating stocks to increase income potential from your investment. So there are two key things to look out for in this video. The first one is covered calls. The second one is dividend generating stocks. And when you combine these two items, you can come up with a strategy that can give you double-digit cash flow returns on your investment portfolio. I can imagine if you're generating double-digit returns, it reduces the panic when you see prices of stocks going down and helps you to think long term, because eventually the prices of these stocks will go back up. But the covered call helps you to think long term. You could look at it as reducing your cost basis on those stocks or creating income for yourself from your investment portfolio while you tide this downward trend. Let's look at the details of this and see example trades that you can execute on. So before we proceed, let's talk about the basics. If you already understand these basics, please be patient. We will get to the point of this video. But for those who are new, we will quickly run through these definitions because it will help you to understand the strategy that we're trying to explain today. First, we want to talk about options. So what are options? An options contract gives the owner of the contract the right, but not the obligation, to buy or sell multiples of 100 units of a stock at an agreed strike price on or before a predetermined expiry date in the future. So that's what the options contract is. And there are two types of options contracts. You can have a call contract or you can have a put contract. A call option contract gives the buyer of the contract the right, but not the obligation, to buy multiples of 100 units of a stock at an agreed price on or before a predetermined expiry date in the future from the seller. The buyer has to pay the seller a premium for this right, and the seller is required to own the said stocks in order to be able to sell a call contract. So it's important that if you are looking at the covered call strategy, which is what we're going to talk about, you need to own the stocks outright to be able to sell a call on those stocks. Otherwise, you would have to look for a different strategy. So specifically for this strategy we're going to talk about in this video, the first step is you need to buy multiples of 100 units of the stock. Then you sell a covered call. And we will see examples in this video to explain what we've just described here. As always, before we proceed, a special plea. If you haven't subscribed to this channel already, please hit that subscribe button. And while you're at it, hit the notification bell so that you're the first to see new videos as soon as they're uploaded to this channel. And if you know someone who will benefit from this channel, please do us a favor, share the video with them post it on your social media feed. We will be very grateful. And if you like the knowledge being shared, yep, tell the YouTube algorithm by hitting the like button. If you've got questions, leave a comment in the comment section and we will get back to you. And you can also check us out on Twitter and Instagram. Thank you so much. Really appreciate your time and support of this channel. Okay, so let's use Microsoft as an example to explain the concept of the covered call. Right now, it is the 26th of September 2022. Microsoft is trading at about $239 per share. Assuming you're a fan of Microsoft and you would like to own the shares, you could go ahead and buy the shares right now, but you could also generate extra cash for yourself as a result of owning Microsoft shares by selling a call on the shares that you've bought. So let's say, for example, Microsoft is selling at 239.55. If you're going to buy 100 units of Microsoft, you're looking at about $23,960 for 100 units. So now let's go into our TradeStation test account. So the first thing you would have to do is buy 100 units of Microsoft shares. So you go and do trade, and then you enter the ticker symbol. Ticker symbol for Microsoft is MSFT. You select Microsoft, and you're buying at market, and you want to buy 100 units of Microsoft. So you click on the buy button, and you can see the summary there. For this transaction, you need $23,955. So if I hit the send button, of course, this is a test account, but as you can see, I now own 100 units of Microsoft, which I have bought at that price. Now, the next thing I want to do is to sell a call on my Microsoft. And so what I need to do is determine at what price will I be comfortable selling my Microsoft shares. So if I say I'm happy to sell my Microsoft shares if they hit 250. So I can then go and look in the options chain and type MSFT, which is this ticker symbol. I expand the view. I click all strikes. So I own 100 shares of Microsoft at the moment. I want to sell a call, and I'm happy to sell that call at 250. So I will want to go further down the option chain, probably to the following month. So October 14 looks like a good month. What is the going price for Microsoft's $250 call expiring on the 14th of October 2022? As we see here, the price is $340, $355. So if I click on that and I select market, so I'm selling one call contract which covers the 100 shares of Microsoft that I own. And if I click send order, it means that net any fees, I'm going to be paid $340 for my Microsoft shares right now as the premium. So I'm selling one Microsoft call contract that will expire on the 14th of October 2022, and the strike price is $250, and the premium is 3.4, so I'm going to get $340 for my 100 shares. And so if I click send and the transaction is executed, when I go back to my portfolio, you can see now I have one call contract, Microsoft shares, expiring on the 14th of October 2022 at a strike price of $250. So now let's look at the analysis for this trade that I've just executed. Okay, let's run a quick analysis on the trade we've just executed. So we bought ticker symbol MSFT, which stands for Microsoft. We bought 100 shares and we paid a total of $23,951. Immediately, we sold the October 14, 2022 250 call and we received a total premium of $335. So the return on investment from the $335 we got paid compared to the 23,000 plus that we used to buy the Microsoft shares is a 1.4% return on investment. And we made that amount with 18 days to go. The next thing to think about is what would we make if we got assigned? So what does it mean to get assigned? If the price of Microsoft rises above the $250 mark before this 18-day expiration period, we will have to sell Microsoft to the buyer of this call contract at 250. And that's the point of call contract. Somebody is taking a chance that Microsoft will rise above $250 before the expiration of the call contract. And for that chance, they've paid us $335. And so if the price of Microsoft goes above 250, we have to sell it at the 250 price that we agreed. Be that as it may, if we got assigned, because we bought at 23,951 and we're selling at 250 per share, we would get an additional $25,000, which means that the profit we would make at assignment would be $1,049. That translates into a return on investment of 4.38% for just 18 days of investment period. The total, when you combine the $1,049 with the 335, the total you will make if you got assigned would be $1,384, which is a 5.78% return on investment in just 18 days. That is not a bad return on investment for such a short period. This is the beauty of the covered call strategy. Right, now let's look at what we can do to find high dividend paying stocks that we can deploy this covered call strategy on. Remember, when we started the video, we talked about the combined strategy here is you want to look for dividend stocks that are in the double-digit return on investment. So you're going to make money from owning those stocks. It will generate cash flow for you. But you're increasing the income generating potential by selling a covered call on the stocks. And there's no better place to start your search than this website here called Finviz. It's a free tool, but the features are absolutely mind-blowing. So as soon as you get to Finviz, you want to click on the screener tab. You want to click on all. You're looking for stocks that you can sell options on. So optionable in the drop down. And then you want to look at stocks that have a high volume. So we'll start at over 1 million. In other words, these are actively traded stocks. Then you want to look for significant dividend yield. Let's start at over 7%. And so we have a breakdown of different stocks in different sectors that pay significant dividend, but we can also sell call options on them. So let's look at the charts. So you click on the charts tab and you want to potentially look for stocks that are trending up. Okay, this looks interesting. So DVN, ticker symbol DVN, seems to be trending up. Now, the next thing we want to do is go on Yahoo Finance to find out more about this stock. So Yahoo Finance is finance.yahoo.com. In the search field, you type the ticker symbol, DVN in this case, and you will be shown the summary information about DVN, Devon Energy Corporation. Currently trading at $56.18, is down 2.63% today, like a lot of stocks in the market. But what is interesting here is the forward dividend yield is 10.75%. And if you look at the charts, you will see it is trending up overall, and it pays dividend every quarter, which is why the forward yield is annualized 10.75%, which is not bad. So this is a kind of stock that you want to own in the long term because you're going to be generating quarterly cash flow. But we're going to see how you can increase your income generation probability from selling a covered call on such a stock. So now we want to look at ticker symbol DVN. So we go and we click on trade. We enter the symbol DVN, Devon Energy. We want to buy 100 stocks because that's what we need to be able to sell a call on it. We're buying it at market. And so we click on the buy. And so 100 units of DVN at market will cost us $5,609. And so when we hit the send button, transaction is executed. And then the next thing we want to do is sell a call on ticker symbol DVN. So we click on it, expand, look at the option chain, and with this strategy, because you don't mind holding the stocks for a while, you can go as far down as possible in the expiry date of the option chain for when you feel comfortable. So let's assume we want to hold this for at least 1 quarter because we want to get paid the dividend that will be earned, as well as earn the income from selling the covered call. So we've bought DVN at about $56. What price would we be comfortable selling it at? I would say if we could get it for $60, we should be fine. So if you sell the January 2023 expiration at $60 for ticker symbol DVN, you could be paid about 5.25 per share. So if we click on that and we go market, so we're selling one call to cover the 100 units of DVN that we've bought. And the summary here is that we will receive $525 in premium payments for selling this call. So when we hit the send button, transaction is executed. And if we check our portfolio, we will see we've got 100 stocks of DVN, and we've got the January 2023 call at $60. One call sold, and we've received our premium. So now let's look at how much return on investment we've generated. All right, let's look at a rundown of the cash flow analysis from this investment. So again, to remind ourselves, the ticker symbol is DVN. The purchase price was $56.07, which means we paid a total of $5,607 for 100 shares. Immediately, we sold the $60 call that expires on the 20th of January 2023, and we received a premium of $5.30 per share, and the total premium received was $530. This represents an immediate return on investment of 9.45% on the capital deployed, which was $5,607. And the days to expiration for this call contract is 116 days. So in 116 days time, the contract will expire. Now there are two scenarios here. If the contract expires and at the expiration, the price of DVN shares is less than $60, the contract will expire worthless because it doesn't make sense for the buyer of this call contract to buy those shares, to exercise his right to buy those shares from this contract when he can get the same shares at less than $60 in the open market. However, if the price of the shares goes above $60, then the contract will be assigned. This means that the buyer of the contract has an opportunity to make some margins because he can buy the shares at $60 from the seller and then go to the open market to sell those shares at the market rate, which is higher than $60. Be that as it may, given that the purchase price of DVN shares at the time of purchase was 56.07, if the price of DVN shares at expiration of the call contract is more than 60, the seller of the call gets to sell the shares at $60. And that means they will receive a payment of $6,000 for 100 shares, which translates to an additional profit of $393 on the $5,607 that was deployed at the beginning of this transaction. This $393 represents a 7.01% return on the capital deployed within that 116-day period. What else could happen? In the 116-day period, as we mentioned earlier, it is most likely that DVN will pay out dividends to people that own the shares. Given what we've talked about, that DVN forward dividend yield represents a 10.75% return, that means there is a potential at that prorated amount for 116 days to earn an additional $191.56 as dividend payouts on the $5,607 deployed to this transaction. If that happens, that will represent an additional 3.42% in returns. So that means the total maximum yield when you combine the $533, the $393, and the $191.56, the total maximum yield that could be generated from this trade over the 116-day period of this contract is $1,114.56, which represents a very good 19.88 return on investment. Generating about 20% return on investment within 116 days of an investment period is not bad at all. So this is a way that you can generate good returns even when the market is tanking. So there you go. As you will have seen from today's video, selling covered calls is a fantastic strategy to be deployed in any market condition, whether uptrend or downtrend, especially when applied to double-digit dividend yielding stocks to create fantastic cash flow for ourselves. As always, If you like the video, please hit that subscribe button. Hit the notification bell if you haven't subscribed already. Hit the like button to indicate how much you enjoyed the video and to tell YouTube to promote this video to others. If you've got questions, do us a favor, leave your questions in the comment section and we will definitely get back to you. And you want to check us out on Twitter and Instagram. Thank you for stopping by. Have a beautiful time and all the best with your investment growth. Take care.